Today we're going to unpack the story of Coloplast, a company that took its absolutely pristine financial reputation and bet it all on a high-stakes gamble for growth.
You know, for decades, if you were an investor, you looked at Coloplast as just a fortress of stability in the medtech world. It was a market leader, incredibly profitable, and honestly, almost boringly predictable. And this number right here, this is why. Back in its 2020 fiscal year, the company was generating a staggering 46% return on invested capital. Just think about that. For every single dollar it put to work, it got 46 cents back in profit. That is truly world-class stuff.
Which really begs the question, why on earth would a company performing at that level decide to completely change its DNA? Why would you trade such a sure thing for a massive gamble?
Because they traded that incredible 46% for this, 15%. Now, 15% is still a respectable number for most companies, but it's a dramatic plunge that signals a massive strategic pivot. So, let's unpack exactly how and why this happened.
Okay, so to really understand the change, we first have to appreciate what made Coloplast the gold standard to begin with.
The company is a leader in what's called intimate healthcare. Its two main businesses, Ostomy and Continence care, make up almost 2/3 of its sales. And these are markets with unbelievably loyal customers, people who need these products for life. That creates an incredibly stable, reoccurring revenue stream that investors just love. Now, in the investing world, we talk a lot about this concept called an economic moat. It's basically the competitive advantage that protects a company from its rivals, just like a real moat protects a castle. And Coloplast's moat, well, it was legendary. It wasn't just about having a better product. It was this whole 5-pillar system that built these incredibly deep relationships with doctors, with patients, and with the insurance companies paying the bills. It created an ecosystem with super high switching costs that basically locked customers in for life.
But here's the twist. That amazing stability? It wasn't enough. Management wanted faster growth, and so they launched a brand new strategy to get it, and they called it Strive 25.
And just look at the shift here. It seems subtle, but it's profound. The old plan was for steady 7 to 9% organic growth. The new ambition targeted just a little bit more, 8 to 10%, but changed the engine completely. Growth would now come from buying other companies, major acquisitions. Coloplast was going shopping. And boy, what a shopping spree it was. First, they dropped over 2 billion euros to buy Atos Medical, which got them into the voice and respiratory care market. Then, they spent up to $1.3 billion on Kerecis, a really fast-growing company with a wild new wound care technology that actually uses fish skin. These two deals changed everything.
Which brings us to the financial consequences of this huge bet. So what was the real price of all this new growth?
Well, this before and after table tells the whole story. Return on invested capital crashed from 45% to 15%. Net debt, it exploded by more than 10 times. And those best-in-class profit margins, they got squeezed. This, right here, is the new Coloplast.
You can see it so clearly here, that step-by-step drop in capital efficiency as each one of these massive debt-fueled acquisitions hits the balance sheet. This was a very deliberate trade-off. They sacrificed those stellar historical returns for a shot at higher future growth.
And that debt load is a really big deal. The company's gearing ratio, which is just a key way to measure leverage, jumped from a nearly debt-free 0.2 times its earnings to a much more substantial 2.5 times. This adds a whole new layer of financial risk that just wasn't there before.
But this transformation didn't happen in a nice, clean vacuum. Just as Coloplast was trying to digest these enormous deals, it sailed directly into a perfect storm of new headwinds.
I mean, the timing really couldn't have been worse. The CEO stepped down, creating leadership uncertainty. They had a product recall, they had a slowdown in the super important China market, and at the end of the day, they had to lower their growth guidance for the year. It's been a real period of growing pains.
But you could argue all of those are just short-term problems. There's a much bigger, scarier threat looming on the horizon for the company's core business.
And that threat can be summed up in just 3 words: U.S. competitive bidding.
So here's why this is such a big deal. The U.S. government is proposing to force suppliers of ostomy and urology products to bid against each other for Medicare contracts. Now, this almost always leads to major price cuts. And for Coloplast, this directly threatens the profitability of its single most important growth market.
Okay, so let's tie all of this together.
With this completely new risk profile and all these new challenges, we have to ask, what are investors actually paying for when they buy Coloplast stock today?
The whole debate really comes down to this. The bulls, the optimists, will tell you Coloplast is still a best-in-class leader with a powerful moat, and now it has added 2 exciting new growth engines. But the bears, the pessimists, they'll point to the extreme price of the stock, the high risk of actually integrating these acquisitions, the new debt, and of course that looming regulatory threat in the US.
And that premium price is really stark when you see it laid out. Investors are paying nearly 32 times earnings for Coloplast. That's almost double its closest competitor. The main justification for that premium lies in its return on equity, which is still far superior. So the market is definitely still pricing it like a premium business.
Which leaves us with the final multi-billion-dollar question. Coloplast has fundamentally changed its identity. It has traded financial perfection for a chance at faster growth. The company is now riskier, it's more complex, and it's more leveraged than ever before. So for investors, the question is simple. Is the new story worth the old price tag?